Welcome back to Investing Talk Podcast.
Today we're looking at USA rare earth.
As usual, before we start, subscribe, like, and comment to this video to support the show.
You know, when we talk about mining on the show, the mental image is, well, it's pretty standard. You think excavators, dust, big holes in the ground.
Right.
But looking at the research today, that framework, it just feels totally inadequate. If you frame this company as just a miner, you are missing the entire point.
Okay.
The thesis we're looking at is what they call mine to magnet.
I have to admit, I've seen that phrase. It's been popping up in their investor decks, a few reports. And to my skeptical ear, it sounds a bit like a marketing slogan.
A little bit, sure.
Yeah, like it's designed to distract from the financials. It's catchy, but what does it actually mean?
It sounds like a slogan, I'll grant you that, but it's actually a geopolitical strategy disguised as a business plan. The goal here is it's a fully integrated, Western-aligned supply chain, one that's completely independent of China. We're not just talking digging dirt out of the ground.
Right.
We're talking processing that dirt into oxides, turning those into metals, and then turning those metals into high-performance magnets for fighter jets, for electric vehicles.
That's the vision. And it sounds grand. I get it. It sounds, frankly, patriotic. Who doesn't want domestic supply chains?
Exactly.
But my job is to look at the reality of today, not the dream of tomorrow. And the reality is, right now, this is a development stage company. The revenue, when I look at the top line, it's zero.
Well, that's standard for this stage.
Not $1 million, not $1,000, $0.
You can't sell what you haven't built yet, you know?
It might be typical, but it makes it incredibly risky for anyone listening who's used to buying, say, established blue chips. You have a promise of future production versus a very real, very current cash burn.
Right.
We're looking at a company trying to survive what they call the valley of death.
And that's a crucial concept here. For anyone listening who isn't, steeped in venture capital or junior mining, the valley of death is that brutal period. It's between raising your initial money and actually selling a product.
Right. Keeping the lights on.
Exactly. They have to pay the engineers, keep the permits moving, all until production starts. And that's not scheduled until 2028.
That is the tension. It's a race against time, a race against solvency. They're running a marathon, but sprinting to stay ahead of the bills.
But here's the other side of it, and this is why I'm looking so closely. If they bridge that gap, if they survive that valley, they capture the defense and EV market in a way almost no other Western company can. They become the bottleneck breaker.
Okay, let's unpack that. We need to look at the hard numbers before we get too carried away with a geopolitical narrative. The story is great, but the math has to work.
Agreed. Let's get into the fundamentals.
Revenue, as I said, is zero. No money coming in from operations. And the recent earnings report, the earnings per share, EPS, came in at a loss of 25 cents.
It was a miss, to be fair.
A big miss. I mean, the consensus was a loss of only 6 cents. So they're losing money 4 times faster than the street expected. That sets off alarm bells for me.
You have to contextualize that loss, though. This is pre-commercial. They're not losing money because they can't sell widgets or because margins are compressing.
They're losing it because they're spending it.
They're spending it heavily on development, pouring capital into engineering, permitting, infrastructure. If they weren't spending that money, I'd actually be more worried. It would mean the project stalled.
I get that you have to spend money to make money, but the balance sheet health is a massive concern for me right now. We're looking at negative equity, a heavy debt load relative to their cash on hand. There's no free cash flow. They're literally burning cash to build this dream, and that runway isn't infinite.
They are burning cash, yes, but the data shows they're also finding cash. That's the counter argument.
Okay.
You have to look at their ability to raise capital. Look at the money they just brought in. They secured a $75 million private investment, a PIE deal in 2025. Specifically to fund the magnet manufacturing side.
That's a lifeline, sure. But PIE deals can be expensive money. They can mean significant dilution.
It's more than a lifeline. It's validation. Smart money doesn't throw $75 million at a sinking ship. And if you want to talk institutional confidence, look at Altfest LJ & Company.
What they do?
In Q3, they took a massive position, bought over 700,000 shares.
Wow. That's what, about $13.5 million?
Exactly, $13.5 million.
Right.
When an institution drops that kind of money into a pre-revenue company with negative equity, they're signaling one thing.
That the reward outweighs the risk.
They believe the dilution is worth the potential reward. They're betting on the moat.
Let's talk about that moat. Because From a numbers perspective, just looking at spreadsheets, I see a hole in the ground and a lot of debt. Why is this different from, say, MP Materials, who are actually producing revenue right now?
It comes back to that mine-to-magnet strategy. Most competitors do one piece of the puzzle. They mine the ore, then they ship it usually to China to be separated.
Yeah.
Then somewhere else to be turned into alloy. It's disjointed. USA Rare Earth is building 4 distinct assets that link together. First, you have the Round Top deposit in Texas.
Which is heavy rare earths and lithium. We should probably clarify heavy for people listening. Not all rare earths are the same.
Good point. You have lights and heavies. Light rare earths are, well, relatively common. Heavy rare earths, like dysprosium and terbium, are much scarcer, much harder to process.
But they're the critical ones.
Absolutely critical. They allow magnets to operate at high temperatures, like inside an EV motor.
Right.
Or a missile guidance system. And Round Top is rich in these heavies. That gives them a huge advantage.
And that production timeline. They've moved it up to late 2028.
Right, so that's the mine, Asset 1. But then you have the Stillwater Magnet Facility in Oklahoma. They aren't shipping the ore to China. They're sending it to Oklahoma to make the actual magnets.
So it closes the loop domestically.
It closes the loop. They control the feedstock and the final product, cuts out the middleman, secures the supply chain. But then, and this is what a lot of people miss, they're expanding into Europe. They have a facility in France, capacity of 3,750 metric tons per year. And that facility has French government backing.
Government backing how?
Through the C3IV credits.
C3IV? Sounds like a droid.
It does, doesn't it? It's a tax credit for investment in green industry. It's basically the French government subsidizing their factory build-out. So they're leveraging government anxieties on both sides of the Atlantic.
Okay, so that's 3 assets. You said 4.
The fourth is the acquisition of less common metals, or LCM. This gives them immediate expertise in alloys. Making the metal is one thing. Mixing it into the specific recipe for a high-performance magnet, that's a dark art.
Right, it's chemistry.
Chemistry and physics. LCM gives them that IP, that know-how right out of the gate.
So the moat is that they aren't just digging dirt. They're making the final product for the Western world. If you're a defense contractor, you just buy the finished magnet from a U.S. company.
Precisely. It de-risks the entire supply chain for the customer.
I see the logic. It's vertical integration as a survival strategy. But investors can't eat strategy. They need the stock price to go up. So let's pivot to the charts.
Let's look at the technicals.
So despite that earnings miss I was hammering on earlier, the 25-cent loss, the stock acted strangely bullish. It actually climbed, 18.9% after the bad news.
That is a classic sign of what we call psychological resilience. When a company drops bad news and the stock goes up, it tells you that bad news was already priced in.
The sellers are gone.
The sellers are exhausted. The market stops caring about this quarter's loss and starts looking ahead at the future milestones.
It's trading around $14.50 as of late December 25. Seems to have found a floor there.
And if you look at the momentum indicators, the story gets more interesting. The 14-day RSI, the Relative Strength Index, it rose from oversold levels.
And for anyone listening, the RSI is basically a fuel gauge for momentum. When it's down near 30, the tank is empty. Everyone who wanted to sell has sold. So seeing it climb from there is often a reversal signal.
Exactly. And we're seeing higher lows forming. The chart is starting to build a staircase up. It's not a rocket ship yet, but the trajectory is shifting.
I'm also looking at the volume. It's unusually high. This isn't just retail investors day trading. It looks like heavier activity.
Right, but you have to be a little careful with that volume interpretation because of the ETF factor.
That's a good point. These leveraged ETFs like Traders USAX, they drive a huge amount of volatility into these names.
A huge amount. So some of that volume is structural. It's funds rebalancing or chasing momentum. It creates noise. But even accounting for that noise, the price action suggests accumulation, not distribution.
Big money is quietly stepping in.
That's what it looks like.
So the chart looks constructive, even though the fundamentals are, well, non-existent on the revenue side. Let's look at how the street feels about this. Moving to sentiment.
The vibe is definitely changing. It feels different than it did 6 months ago.
It is surprisingly optimistic. I pulled the data on recent headlines, and 4 out of the 5 major ones have a bullish sentiment score.
That's a strong ratio, especially for a junior miner.
It is. The weighted sentiment comes in at strongly bullish. The average score is about 0.51. For a company burning cash like this, that is rare.
I think the analysts are looking past the burn rate. The consensus rating right now is a moderate buy. They're seeing the forest, not just the trees.
And the price targets reflect that.
They do. The average price target is $26.33. The high estimates go all the way up to $40.
Okay, let's just pause on that. The stock is at $14.50. The average target is $26.33. That's nearly a double from here.
It's massive implied upside. But remember, that upside is contingent on perfect execution.
So what's driving this mood? Why are analysts so willing to overlook the losses?
It's the macro environment. You have a massive push for U.S. mineral independence. You've got bills in Congress, directives from the Trump administration. They all point in one direction.
We need domestic supply.
The government is practically screaming for companies like this to succeed.
And the European angle helps too, I imagine.
A huge help. The EU Critical Raw Materials Act favors their expansion in France. So they're aligning with national security priorities in both the U.S. and Europe. They aren't just a company, they're becoming a strategic asset.
There's also some chatter about government reserves.
Right, the rumor mill. Speculation about a U.S. government strategic resilience reserve. We're talking about $2.5 billion to stockpile critical minerals.
If that happens, a company like this would be a prime beneficiary.
Exactly. Even a fraction of that would completely change their balance sheet risk. It basically acts as a government backstop.
But rumors don't pay the bills. And we need to be realistic about what could go wrong here. Because if this was a sure thing, it wouldn't be trading at $14.
No, it would be trading at $50.
Exactly. So let's get real. I want to look at the risks.
Let's do it. You have to look at the downside.
Risk number one for me is financial precariousness. I cannot stress this enough. Zero revenue means they are entirely dependent on raising funds, which means dilution.
Explain that for anyone who might be new to small caps. Why is dilution the enemy?
Imagine the company's a pizza. You own a slice. When they need more money, they cut that pizza into more slices and sell them. Your slice gets smaller.
You own less of the company.
You own less than you did before. And every time they raise cash to keep the lights on, existing shareholders get watered down.
That's the cost of doing business in this sector, though. You pay with equity to survive.
It is. But that valley of death until 2028 is a long time. That is 3 years of burning cash before the mine is producing. A lot can happen in 3 years.
A lot. Markets can crash, financing can dry up.
And I'm not the only one worried. Risk number two, the short interest. The skeptics are loud, and they're putting their money where their mouth is. Short interest is high 17.45% of the float.
That is significant. Nearly 1 in 5 shares is being bet against.
And it's spiked almost 37% recently.
Yeah.
That tells me smart money, or at least aggressive money, is betting on a drop. They're betting on an execution failure.
Or they're hedging. But yes, a spike like that is a red flag. It means there are sharks in the water.
That leads right into risk number 3, execution.
This is the one that keeps me up at night on this story.
Explain the logistics here. Why is this so hard?
Just think about what they're trying to do. They're building a mine in Texas, simultaneously a processing lab in Colorado, a magnet factory in Oklahoma, and they're expanding a facility in France.
That's a lot of moving parts. It's like trying to conduct 4 orchestras at once.
It is a logistical nightmare. Any one of those projects is difficult. Doing all 4 at once across 2 continents, the complexity is off the charts. Everything has to sync up perfectly.
And delays in mining are almost guaranteed.
Exactly. Permitting delays, construction delays. Now they have partnerships with Fluor and WSP, which are top-tier engineering firms. That helps mitigate the risk. But if that Texas mine gets delayed by even a year,
the stock gets crushed.
Crushed, because the cash burn just keeps on going without any revenue to offset it.
So we have a massive potential upside, driven by geopolitics and a unique business model, balanced against a precarious balance sheet and a logistical high-wire act.
That's a perfect summary. High risk, high reward.
Let's pivot to the final score. What's the verdict here?
When I weigh that mine-to-magnet moat against the financial risks, I keep coming back to the strategic necessity of this company. The West needs this to work. We literally cannot build fighter jets without these magnets, and we can't rely on China for them forever.
So what's the number?
I'm giving this a bullish score of 8 out of 10.
8 out of 10. That's high for a pre-revenue company.
It is a high conviction play for me. My thesis is simple. This is a bet on deglobalization. The world is breaking into blocks, and USA Rare Earth is positioning itself to be the supply chain for the Western bloc.
And you think the discount is real?
I do. They're trading at a deep discount to that $26 fair value. The market is pricing in the fear of dilution, but it isn't fully pricing in the strategic value of what they're building.
And the government support.
That's the safety net. The U.S. and French governments are not going to let these initiatives fail easily. They have too much writing on it. That provides a floor that a pure private company just doesn't have.
So this is a long-term hold.
A multi-year hold. You're buying this to hold through the volatility until that 2028 production ramp. You put it in a drawer and try to forget about it.
It's a bumpy ride to 2028.
Extremely bumpy, but if they pull it off, it's a multi-bagger.
Yeah, that's the breakdown. If you want to follow this journey to 2028, make sure to subscribe, like, and comment to this video to support the show. We'll see you on the next one.